The final category of markets that we will review are currency-based markets, otherwise known as foreign exchange markets. These are markets where individuals can buy, sell, or exchange currencies, very similar to equity and bond markets. The foreign exchange markets, otherwise known as Forex, is the largest financial market in the world, which is open 24 hours a day, only closing on the weekends. Trading within these markets is always done in pairs, so the value of one currency is relative to the other. The most liquid pairs in Forex are the euro to dollar pair, followed by the dollar to yen pair, then the pound to dollar pair. One benefit of Forex includes the very little capital required to maximize profit potential. Now, similar to derivatives, Forex is required to be traded on leverage, which maximizes capital and can lead to great returns. Forex, in fact, has some of the highest leverages available in the public markets. While options and futures typically offer leverage ratios of about 1 to 100, Forex exchanges can offer ratios of 1 to 1,000 and even greater. CM Index, for example, is a Forex broker which allows up to a 1 to 8,888 leverage ratio. This means that $1,000 of personal trading capital can allow for over $8 million of borrowed capital. Of course, this seems rather ridiculous, and honestly, can be very difficult to really wrap your head around. The thing with Forex is that price movements are extremely minimal. Often within these major Forex pairs, you will only see price movements of about 1 cent a day or even less. This is why the leverage ratios are so significant, so it is a little bit deceptive. Another benefit to Forex is that its price action moves organically as well, similar to stocks, bonds, and futures. There is no implied volatility, time decay, or any of the Greeks when dealing with Forex, which is always a nice addition. And I also want to mention here that organic price action is not supposed to be a particular form of price action. It is simply price action that moves from price action alone. So, while Forex and, say, bonds both offer organic price action, it is not to say that the price action of these markets is the same. Every market will have its own personality in regards to how it moves, which is very important to understand. Another characteristic of Forex markets, which can be seen as good or bad, is the lack of rules and regulations involved. This, of course, increases the freedom that the trader has in regards to their position executions, which can be a very good thing. Now, this could also be a bad thing, since the lack of regulation is now put on yourself, making yourself accountable for managing your risk and everything that goes into trading. Commissions can also be reduced significantly in Forex, which can be specifically beneficial for high-frequency scalpers who may enter and exit hundreds of positions a day. While there is a lot more to go into in foreign exchange markets, I have never personally participated within these markets, so I do not have the confidence to talk about it as I do the others that we have discussed. For this reason, if you do have any questions in regards to Forex markets, I cannot guarantee that I can hold to your expectations, but of course, I will help you as best I can. That being said, most of what I will be talking about throughout our offerings is not specific to any market, and if it is, will be explicitly mentioned. While markets do contrast in many ways, they are not inherently different from each other and are simply variations of each other. Before we move on to different types of trading styles, I would like to remind you that it took me over a year to determine what financial markets I preferred. I began with penny stocks, which I then moved to indices, followed by options, to now where I actively trade futures. Do not think that you have to determine what is best for you right now. Throughout time, you will begin to better understand what you like and what you don't like. If you don't know where to start, I have created a very brief diagram to help you determine what is right for you in the simplest format possible. This diagram can help you understand where you stand in regards to your risk profile, capital, and experience level. When looking at this diagram, ask yourself these questions. Do you like risk, or do you want to avoid it? How much experience do you have? How big or small is your portfolio size? Below these questions are the markets which I believe would suit you best. For efficiency reasons, I will continue, but please feel free to pause whenever you feel necessary. Below the third question, you may have noticed that all markets we have covered are under those with high capital and those with low capital. This is because capital does not matter when starting out. And that is a point I want to make very clear. as my lack of capital when I started out has always increased my doubt that I can make it in this game. And the truth is, people are impatient and believe they need a significant amount of money in order to make money. Now, I'm not going to deny that there is some truth in that statement, but equally as so, the number in your bank account does not change whether or not you can learn. More money in this industry has zero effect on how you learn and how fast you can learn. Remember, in order to be successful in this business, you need to focus on the process, not the profits.